Good morning. I hope you're all well. Well, it's a good morning from a very icy Cape Town. Snow in the mountains, and it seems like the weather, like our government, is doing its worst. But I hope that you are still doing well. The markets seem to be muddling along as we expected. Global markets troughed about 6 months ago, towards the end of last year, and have been in a steady recovery since, as we expected. And then May, the seasonality, the sell in May and go away, the weakness in global markets arrived as expected as well. What wasn't expected, certainly from our front, was all the own goals that South Africa scored this month. It really is just beyond words, unfortunately. I have a separate slide on that, on the Rand in terms of our outlook. Fortunately, it's not only threats, there are opportunities, and I'll be talking about both the threats and opportunities on the South African slide. And then I have a special extra slide on the Rand right at the end, and I'll talk about our views on the Rand, where we see it going, why, and what's caused the Rand to be as weak as it is in the current environment. It's not all because of South Africa, but it is certainly mostly because of South Africa, unfortunately. But anyway, let's get back into global markets. How did things behave in May? Well, it was, as I said, certainly a sell in May and go away month. We did put on protection in April, and so that did work well for our portfolios, being slightly underweight equities going into the seasonal volatility that is the middle of the year. Nothing unexpected about that. What worked well, you can see that Japan, 12.4% return in rands. That helped the portfolios. We are overweight Japan on structural reforms that are underway there, and it seems to be quite an exciting place. Also very cheap, so a nice value play with some structural catalysts. We're also overweight China, as you know. That's one of our key long-term themes. China there being the worst performer for the month besides South Africa, and that was quite surprising. Not because it hasn't done well, just because it didn't do as well as expected. So the Chinese surprise indicators pulled back, but that wasn't because China's growth didn't accelerate. It just didn't accelerate as much as people were expecting. So this the recovery from COVID and the lockdowns is still well underway, still looking very strong. It's just going to take a little bit longer than people expected, and I will talk more about that on the China slide. Then obviously the most interesting one, and that everyone's talking about, is the FANG fund. A FANG up another 20% for the month of May. The one-year return on that fund is now 60%. The fund that's number 2 in that category has a 40% one-year return, so there's a 20% difference there. The fund doing phenomenally well, and we are very proud of that performance. But we are certainly looking to take some profits and rotate out of some of those stocks, because while artificial intelligence is certainly a game changer, and large language models is certainly going to make things different going forward, I think it's not everybody's going to be a winner. And there's some very interesting data points that have come out from BCA on that. They say that if Google was to replace its current search engine with a ChatGPT type, or Google has Bard, but if they were to replace Google search with a Bard search, it would cost them an extra $30 billion a year in computing costs, another $100 billion in capital spending. When you have to fire a lot of people to recover that sort of spending. And the thing is that everyone has to do it, all the competitors have to do it, and the only real winners are the consumers. And it's certainly not sure if the consumers are going to pay more for something that everyone is providing. And we're seeing that right now with all the content providers and how they are busy fighting and cutting costs, and the EV providers, how Tesla's cutting costs. So, it's not necessary that technology means that they will all be winners. Another interesting data point on that is just how it plays out. So right now, you search for something in Google, and a lot of the top advertising slots will show before the Google slots show, and it works quite well. Google has its own answer, but you look at advertising to see what else is out there. But if AI is so good, and if AI gets to the point where you put in a question and it gives you the only answer, the right answer, the answer that is just perfectly suited for you, then why would people bother advertising? Certainly the one that's going to get chosen isn't going to advertise, because they know they're going to get chosen by the AI algorithm. But the other ones are also not going to advertise because they know they're not going to be chosen. So, there's this conflict to having the perfect solution or the better solution, which just means that people might do less advertising, and then the whole business model goes away. So, very exciting space. We certainly are looking at it pretty closely. It is a big part of the FANG fund. We have exposure to all the AI beneficiaries. And the fund is doing very well, but given its very strong performance, we are definitely taking some profits within that fund. But exciting times, certainly. Then, as last but not least, you can see the worst performers there: SA equities, SA bonds, and then SA cash, which you can see the opposite of dollar cash being up 7% for the month. So certainly South Africa, the big loser this month, the month of May, and that was pretty much the biggest loser out of any other market in the world. Certainly understandable given all the risks that have arisen, but still quite a phenomenal move in the markets. Okay, so let's look at the US. And here we've got talking about the debt ceiling, which has really been a bit of a storm in a teacup. So I'm actually not going to talk about it much. The bottom line is that it's not going to have a big impact on the US market. The spending that happened, sorry, apologies, I skipped the global slide. So let's look at the month of May from a global perspective before I jump into the US. So what is interesting is from this chart is just this huge bounce in positive earnings surprises that have come through in the US. So that's the dark line. You can see up nearly 15%. That's earnings surprises. That's to the upside. And it's one of the reasons why we are convinced that the US is not going to hit a recession this year. Maybe early next year or a soft landing, but certainly not a deep recession. In fact, the US technically did have a recession last year, and the markets did fall 25% last year. So I think we may be through the worst. In fact, I'm very sure we are through the worst when it comes to the US. So why was there so much volatility in May? Why did markets fall so much? Well, there was the big concern about the debt ceiling. We had credit tightening with the US banks post the failures. PMIs kept falling. But on the other side, what keeps keeping us bullish is this chart, just that earnings have been incredibly strong in the US, way stronger than at any point in the time, or they've never been this strong in a recession ever. So the earnings just say that the recession is not happening anytime soon. Plus, we've got falling oil prices, we've got falling inflation, we've got Europe and China recovering, we've got very high cash balances, and it all points to at least a balanced economy, or something that's muddling along. And so, our base case is that we're not going to see the pullbacks that we saw last year. Sorry, this is the slide I was talking about. Got ahead of myself, but we've got US Treasury Secretary Janet Yellen warning of a constitutional crisis when it comes to the debt ceiling, which is now passed. Biden signed the bill into power over the weekend, and there's no more debt ceiling crisis. More importantly, the amount of spending that was cut was not that severe, so the amount of fiscal negative impulse to the US is not very strong, and things will continue to muddle along. And despite all this noise and all the concerns and all the risks and the bipartisan polarizing between the Republicans and the Democrats, it's all past us for the moment. So we can just look down into the fundamentals in the US, and the right-hand chart there shows that unemployment is going to continue to weaken. There were some very strange numbers that came out of the US where employment still looked quite strong on Friday, but that's because of the model which adjusts for deaths and over adjusted for the mortality rate. But if you look through that, unemployment is certainly weakening, and the unemployment rate did actually rise to 3.7% in the US. And we are expecting the unemployment rate to continue to rise, and housing has weakened and manufacturing is slowing down. But inflation is also falling, and the bottom right-hand chart there just shows that the Fed funds rate is now above inflation, which means the Fed can afford to pause. There's no need for the Fed to panic and raise rates further and cause a big recession. But as we've been saying for the last 5 months, we're in it for a higher for longer environment. Rates are going to stay higher for longer. The pause is going to be go on for quite some time. Now, actually, the average pause has been about 8 months. So the average pause is longer than people think. And we think that it'll be even longer than that this time, that inflation is not going to fall as quickly as the market expects. The market is expecting a rate cut this year, which we don't see happening. But at the same time, the Fed's not going to be forced to hike. So we've got this higher for longer rates, higher for longer inflation, which unfortunately means higher for longer volatility. And the soft patch is only going to be towards the end of this year, maybe beginning of next year, but certainly not a deep pullback or a deep recession. And that means that the US market, while we remain underweight, should see some good rotation out of the quality growth stocks, which have been worked incredibly well this year. The AI stocks, as I've said, the FANG stocks have been the only generator of performance in the US. So we're likely to see some rotation out of that into the more traditional industrial and bank stocks in the US, as there's more certainty that the US is not going to go into a deep recession, that unemployment is going to fall, but not fall massively, and that it is going to be a soft patch rather than a deep recession. So we remain underweight the US, remain overweight US value, and we think that that's a way to play the US market. And we remain overweight healthcare as well, which also talks to being higher inflation and higher rates for longer. So it's more a defensive spend. So no change in our US view. I think some very interesting data points coming out of China this month. China, in its strongest retaliation yet in the mounting tech war with the US, banned the sales of Micron, that's a US chip manufacturer, Micron products in the country. And we're starting to see the debate about China increase. It's always been, at least for the last year, it's been very, very, very polarized, whether you think China is investable or is not investable. We remain in the camp that says China is investable, but certainly there are high geopolitical risks. But I think what we're seeing is that China is just getting along and making its own friends and its own trade partners. And the US is becoming increasingly insular, and it can afford to be. I mean, the US, only 10 to 15% of its economy is based on imports and exports, so it can afford to be insular. But the rest of the world depends highly on China, whether it's Europe or Japan or Taiwan or Korea or South Africa. We all depend on China. It's not that easy to suddenly exclude China from global trade. And what we're seeing, in fact, is an acceleration of globalization. We're seeing an acceleration in Chinese trade, but it's all happening to the south. So I've spoken in the past about Brazil and China striking a deal to settle trades in their local currencies. That's happening now. India and Malaysia have signed an agreement to ramp up usage of cross-border business using the rupee, Indian rupee. Even France, and was supposed to be a big US ally, France is now starting to complete transactions with China in Chinese yuan currency. So the rest of the world is just getting along with it. And so globalization is not dead, but it's moved south. And trade has grown 11.4% over the last decade in the south. And when we're seeing that in South Africa, Huawei phones are now very, very, very widely held across Africa. Chinese brands are displacing Peugeot and Ford in Latin America. I've mentioned that Brazilian shipments of iron ore to China are happening directly and in yuan. India is importing Moroccan fertilizers in rupees. Egypt is purchasing Russian wheat. And so there's just a rebalancing away from the US and towards China. So if anything, this weaponizing of the dollar and the US pushing its weight around is just causing the rest of the world to find new ways of trading. It doesn't impact the US, because I said they are quite insular, but it does mean you have to identify who are the winners of this move long term. And we're talking, this is not overnight, but long term, the winners are going to be those neutral parties, those neutral countries that can trade both with the US and with China and the rest of the world. And certainly, some of the big winners there are India, Indonesia, and Brazil. Unfortunately, South Africa, not so much, because although we are neutral, we seem to not understand what the word neutral means. And that is what, one of the big shocks that happened this month. But the bottom line is, China is something that's not going to go away. It's just not something that we can ignore and say that it's going to collapse once the US decides it doesn't want to play nicely with China anymore. But geopolitical risks remain, certainly. And investors are right to fear that Xi Jinping can certainly make very, very dramatic shifts in policy overnight without discourse and without seeking approval from anybody. But China's been like that for the last, for as long as it's been involved in the market. So it's not a big change from what they've been doing in the past. Maybe it gets more volatile. But certainly China remains an important cog in global trade. China accounts for 90% of global Windows PC production. That's, if you've got a laptop that is Windows based, 90% of the world's Windows laptops and desktops are made in China. 67% of smartphones are made in China. 85% of global EVs are made in China, particularly on the battery side. So it's just a very, very, very important cog. So it's very interesting to see how things are playing out. We remain overweight China, certainly a surprise to the downside in May, even though it's still accelerated. The top right-hand chart is quite interesting. It shows in the light blue line, the business survey, corporate profits, which has ticked up very nicely, and then trailing EPS, which tends to lag that, which is also turned, but still has much further to go. So we do think that earnings are going to carry on rising in China, and that despite this disappointment in May, that China is a place to remain invested in. But what is quite fascinating is to see the bottom right-hand chart, which just goes to show how investors have positioned because of the geopolitical risk. They said, listen, well, we can't handle what's going on in China, so let's invest in the big players, the global players in the developed world. And certainly our funds have all that exposure. So our funds are overweight, overweight global earnings and global equities, and when that the biggest exposure is to the US. Second is to Europe and Japan, and so we have big players like Richemont, and everyone knows that Richemont's done incredible, and Richemont's even in the South African index. And those plays, so the light blue line, you can see there how the developed market Chinese plays tracked the direct Chinese plays for the past 14 years, and then it's only over the last 2 years where, because of the perceived risk of investing onshore in China, that there's been this huge divergence. So if you invested in Richemont, your return has doubled. You can see that 200. If you're invested in luxury players that are listed in China, your returns have been flat over 14 years. And that divergence over the last year is just showing huge political risk premium that is priced into China. Now, that may stay like that for another year or 2 years until people get comfortable. But I think when you're looking at that huge spread, a doubling of returns, certainly a lot of the risk is priced in. And when it comes to Chinese tech, there's definitely some fantastic Chinese tech companies. Baidu is the one that we hold in the FANG fund. It's trailing on a 19 PE, and it's got a very interesting LLM AI model called Ernie. Or you can hold NVIDIA, which you also hold in the portfolio, at 190 PE. So you have to say, should Chinese AI stocks traded at a 90% discount to US stocks? I don't know if that's the case. You look back 15 years, Tencent traded at a massive premium to Apple. Now Tencent trades at a huge discount to Apple. So I'm not calling the bottom of this anytime soon. I'm just saying that a lot of the risks are priced in, and things on the grounds continue to get better. We saw tourism on the 1st of May holiday jumped 130% relative to May last year. So that the opening up of China from the lockdown seems to be working well. And yes, there were concerns that COVID is accelerating again in China, but that hasn't impacted the lockdown levels at all. So certainly things continue to open up, and we continue to believe that although this was the worst performer of the month of May after South Africa, that it is still warrants an allocation in our themes. as part of emerging markets and as part of the next billion global consumers that will arise. And remember, that is the strategic reason why we hold emerging markets, because EM Asia, of which China is a part, it is forecast that the next billion consumers will come from that region. China being the biggest increase in number of consumers, India the second biggest, despite India actually having a bigger population. But when it comes to wealth, it'll be China driving that spending, not India. Okay, so on to South Africa. We had a number of own goals this month. Here we have President Cyril Ramaphosa talking about the allegations that the US made that South Africa is supplying weapons or arms to Russia. And his response was that the accusations were distasteful. Not that we didn't do it, but that the way the US accused us was distasteful. So that's was certainly not a denial, which we were all looking forward to. And then we had the joint naval exercises, and then we had South Africa grant Putin or all people attending the BRICS summit in South Africa diplomatic immunity. And it was no wonder that various international investors thought that South Africa's definition of neutral or non-aligned didn't appear to be that non-aligned, and we certainly seem to be leaning towards Russia. And as a result, the rand certainly weakened very aggressively to over 19 to the dollar. We then had to make things worse. We then had the SARB come out and raise interest rates. Now, that is the SARB's role. The South African Reserve Bank needs to target inflation. And when the rand weakens, they have to raise interest rates to try and control demand-driven inflation, to basically slow the economy even further, so that weaker currency doesn't lead to pass-through inflation. That's their mandate. That's what they're supposed to do. And they did it well. They raised rates of 50 basis points. That's what they needed to do. Unfortunately, at the same time, and in later discussions and in later risk outlooks, they weaponized the rand. And they said that they tried to use the rand to encourage the South African government to fix Eskom and to be more neutral in its stance to Russia. Now, those are very those are good things to achieve. Yes, certainly. And we all want South Africa to be more neutral and less Russia aligned. And we all want South Africa to fix South African government to fix load shedding. But to use the rand as a weapon to achieve that, well, you saw what happened. The rand then weakened further from 19 to 20 rand to the dollar, because the Reserve Bank said that unless the South African government fix things, the rand's going to weaken forever. And the rand said, well, fine. If the SARB, whose sole job it is to try and target inflation, are giving up unless we see government reforms, well, then we've got the one silver lining we had in this country, which was the South African Reserve Bank, the one part of the government that was working well and targeting inflation. If they're throwing in the towel, well, then why should we stay invested in South Africa? And the rand weakened accordingly. So while I certainly agree with what the SARB is trying to achieve, and I too beg the South African government to use reason and stay neutral and fix Eskom and just follow the plans that they say that they're going to do, and follow the economic policy that South Africa has, as opposed to ANC ideology. Those are all things that we should be following. It hurt the rand in the short term because the rand was used as a weapon. So here we are. Things are looking pretty bleak, but it's not all bleak. I think that some of those signals were received by some of our politicians. President Ramaphosa appointed an independent panel to investigate the docking of Lady R at Simonstown after he appointed a retired judge. And now there are rumors, whether they are true or not, that BRICS summit might be moved to China, so that we don't have to worry about not arresting Putin, even though we are signatories to the ICC, and we should be, and whether we can even give Putin diplomatic immunity is very unlikely. But also, probably more importantly, the US backed down on the allegations. I think the US realized that they can't use a stick if Russia is using the carrot, and they need to balance their diplomatic relations. So hopefully that will go down well, and we'll see how that all unfolds. But when it comes down to it, and I've said this before, I think that South Africa is not a failed state. Yes, I'm not playing with words. I think the state has failed South Africa, but that's something that's not new. I mean, over the last 20 years, we've seen the demise of the post office, of Land Bank, of Denel, of South African Airways, of SABC, and a number of the state-owned enterprises. The big difference was that Eskom had a monopoly, and the private sector could not step in to try and provide service delivery that the government was not providing. And that's the tragedy of it, is that the government is not providing services to its people. And it's a very strange form of democracy we live in. But the private sector now, since the December 2022, where the 100 megawatt self-provision limit was raised, and NERSA has seen a record level of applications and registrations for independent power producers. And RMB and Lorium and a few others have put together this chart in the top right, where they forecast that the private sector, that's independent power producers, industrial private suppliers, and better generation, and small scale generation, rooftop solar, by 2025 will be producing 25 gigawatts of electricity. Now, that's currently what Eskom produces. So that's equal. So forget the fact that we only have 5 gigawatts shortfall at the moment in terms of our load shedding. And by 2025, we'll have 5 times that, or 25 gigawatts produced from non-Eskom. And yes, that's mostly renewables, and yes, that's not a base load, and you can, there is some sort of multiplier that has to be applied to that, but it just shows that the private sector is coming to the rescue, the Western Cape is coming to the rescue, and there are solutions that will see us through load shedding in the energy sector, just like all the other sectors have happened. Basically, South Africans will stand up and will continue to find solutions themselves, according to the polls, we're going to see a lot of that come through in the elections next year. So that we'll have to wait and see exactly how that turns out. So we are underweight South African equities. We remain being underweight South African equities because we don't see a catalyst yet. And it's the same with the rand. We don't see a catalyst yet for it to improve based on South African issues. In fact, we took more money offshore this month, and we increased our global equity exposure and decreased our South African equity exposure because there really is, we're not sure when that light at the end of the tunnel is going to come. 2025 is unfortunately a while away, and while load shedding might improve, we do have in the short term have the BRICS summit, which could be a massive negative catalyst. So we've got to watch for that, and we await the load shedding to get better. Now, there's also a lot of different news when it comes to load shedding and some fake news. If you look historically, the peak in demand has been the last week of May on the Eskom side, because Eskom raises its rates in June and July for winter tariffs, and a lot of industrial users use June and July to do repairs to their systems, and they take that demand offline. And so we could even be through the worst of load shedding, if history is anything you're going to go by. But a lot of risks remain. So we're going to watch this closely. The one data point that was quite good, although it took much longer than expected, but that's to be expected, I suppose, is that President Ramaphosa did transfer finally responsibility of procuring new electricity generation to our electricity minister, Ramakopa, from the minerals and energy minister, Gwedi Mantashe, which should lead to a faster turnaround of getting more power onto the grid. So that again does mean that even if we have to wait for this private sector to come through, maybe the Eskom supply doesn't get worse. Maybe it stabilizes or even improves under the new electricity minister. But what does it mean for South African investments? So what we did do is we increased our exposure to South African bonds. Now, you might think that's quite risky, but South African bond yields are now, in real terms, the highest in the world. This chart was done in the middle of May before things really got quite scary. We had a terrible return of bonds in the month of May. South Africa now has the highest real returns in its bond market in the world. So it's a very juicy return. Yes, there are risks. But, okay, so let's look at the data. Part of the reason why the rand weakened so much, part of the reason why bonds weakened so much and yields rose, it's obviously all the risks I mentioned, but those risks were translated into the South African CDS, credit default spread. And that rose to above 300. Now, it's only risen above 300 3 times in the past 20 years. Once was COVID, global crisis, where we thought the world was going to be in a whole new space. Once was the great financial crisis of 2008, which again, liquidity crisis, we thought the world was imploding. And then once South African specific was Nenegate, where we thought that corruption had won and that the Guptas had finally got their claws into National Treasury and the Reserve Bank, and that we had no control over corruption going forward. Now, the rand recovered from those 3 things in the past. And if you look at how the rand recovered, well, bonds did incredibly well. And over the next 12 to 24 months, South African bonds and South African retailers rose by over 20%. So if this is another Nenegate or a COVID or a GFC, then we could actually have some pretty decent returns. Now, we're not so sure about the growth side of things. That's why we've increased our exposure to South African bonds, not to South African equities. But that catalyst could come soon, and certainly things are looking very, very cheap. And I'll talk more about the rand after the positioning slide. So that's where we are. It's been a tough May. But overall, our strategy hasn't really changed. The IMF is still forecasting the weakest 5-year growth outlook since 1990. And that fits into our low return, low growth, high volatility environment, which is our 4 Ds: decarbonization, deglobalization, debt, and demographics. And as a result, we have our themes that we think will still grow in that environment: the sustainable economy, emerging consumer, disruptive technologies, and health innovation. And we stay overweight those themes. At the same time, we do think that the Fed pause, which in the past has led to a weaker dollar, and the Fed pause in the past also led to stronger non-US equity returns. And if you look at the charts on the right there, you can see there that despite global growth being pretty dismal at the start of the year, remember we were overweight equities at the end of last year when the world thought it was going to end. We have seen some nice increase in that global growth coming through, which has worked well and worked against the recession forecast. But we still think that the best returns will be from non-US sectors. So we are overweight EM, China, and Japan. We are neutral in Europe. We took profits on our European exposures because it's had a phenomenal year, and there are still some risks there. The war between Russia and Ukraine is not going to go away anytime soon, unfortunately. We're overweight South African bonds. We increased that, as I said. We did take more money offshore, so that ZAR protection, we had to close out some of that ZAR protection, but we still have some on. And as I mentioned, US value and healthcare, we still think it's a good place to be in the US for the higher for longer strategy. So not too much is changing there. Bottom line, I think a prolonged Fed pause is up and coming, which means some deterioration in the economic environment in the US. So the analysts might have to downgrade their H2 earnings slightly, which means more volatility. We think mid-year volatility will stay high. But if you look at the average manufacturing cycle, it's about 3 years, and we are 18 months into that. So I think we are closer to the end, not closer to the beginning of that downturn, which again talks to the soft patch happening and being pretty soft towards the end of this year. Okay, so let's look at the rand. I think it's something that everyone's talking about right now. and certainly foreigners visiting our country are having a fantastic time, enjoying the beauty of South Africa and having fantastic meals and a beautiful wine, and paying a penny for it. So it's something that can't last, or shouldn't last. So this is a bit of this is an actual graph. These are real returns, but it's not how our model works. Our model is a bit more complex. It's just stylized, and I think it shows the divergence of various economies and drivers quite nicely. So this is the 1-year return on the rand, which is the dark blue line. You can see there the rand 1977. It's a little bit stronger today. This was a few days ago. Starting from 15.5 about a year ago, and it's weakened. So that's the dark blue line. The light blue line is emerging market currency basket from JP Morgan, and the red line is the dollar index, or basically it's the dollar against other developed markets, the euro and the yen, and the other developed currencies. So you can see for the first 6 months of this period, how the rand and emerging markets and developed markets all move pretty much in step with the dollar. And that was all pretty much in line. In fact, the rand actually strengthened, weakened less than the other emerging markets and then developed markets. But what we've seen in the last, since year to date, is this huge discrepancy. So you can see that the blue arrow showing that the rand is about R1.50 weaker than it should be relative to emerging markets. And emerging markets, so that's 1977 to this 1830, if you want to call it. So that's R1.50. That's the rand is weaker than emerging markets. And then the emerging markets are about R2 weaker than developed markets. And that's obviously got nothing to do with South Africa. So let's call the top 150 South African own goals. That's load shedding, that's Lady R docking, that's providing diplomatic immunity to Putin, that's the SARB weaponizing the rand. So that's that R1.50 premium that we now trade at, and that's reflected in CDS spreads that I spoke about, and the fact that bond yields are so weak. Then this other premium here, the R2 between developed markets and emerging markets, that's got nothing to do with South Africa. So even if we hadn't scored any own goals, the rand would have weakened to about 18 from early on in the year because of lower growth forecasts. That's China not doing as well as it was expected, and that's seen in commodity prices. So commodity prices have collapsed. Copper, which is Dr. Copper, and it's a proxy for how global growth is doing, has collapsed. And that's despite, we expected some commodities to fall. We definitely thought iron ore and steel would fall because of the shift in Chinese demand, but we thought copper would certainly not collapse as much as it has. And so that's, copper has surprised the downside because of Chinese downside surprises, but also because of global risk off with the US debt ceiling, and some of the other US specific risks that we had over the last few months. But we are copper bulls. We definitely think copper is going to recover. And now that the debt ceiling has passed, we do think that the US is not going to go in for a deep recession. It's going to muddle through. So looking forward, what does that mean? So even if you keep this R1.50 South Africa risk premium in place, so that, let's say load shedding doesn't improve, and let's say there's still a lot of uncertainty about our Russia alignment or our non-neutrality, we can still have a true rand appreciation in the rand, based on emerging markets as a whole strengthening against developed markets. So as copper recovers, and as we go into a stronger end of the year, so not next few months, but by the end of the year, as we have the seasonal strong patch toward the end of the year, and as copper recovers and the emerging the world is basically more certain about growth, well, we could easily be at 16 Rand 50. And if we had to unwind South African risk premium, we could be at 15, but that's not what we're forecasting. We think that the South African risk premium is going to stay in place, and we don't think that the copper prices aren't going to recover to their previous highs. So we think that generally the dollar will weaken a bit. from 107 maybe to 110, and we think copper prices could recover maybe a third of what they've lost. But that still gets us back to what, 1830 by the end of the year. So that's why we have our currency protection on. And we do think that there is some recovery in the rand, not a huge recovery. As I said, fair value probably closer to 1650 on the rand, but that might be 2 years out. By the end of this year, hopefully we're down to 1830. That said, that's our forecast. And the reason why we actually took more money offshore despite our forecast for a stronger rand is that risks have definitely increased. When you've got the SARB weaponizing the rand, things are, we don't know where they can play out. And we've got elections next year. We don't know where that's going to play out. So we've got Rashad Kassim, the deputy governor of the South African Reserve Bank, blamed very negative signals from the government about all sorts of issues. Basically, it's all the government's fault for the rand's weakness. And investors need to know that the government is serious about sorting out its issues before the currency can recover. So he's basically saying, foreign investors, don't come near South Africa, don't touch the rand until the government shows it's serious, which is great. I mean, I'm glad that we are standing up, and certainly the private sector seems to be standing up to the government. Certainly our CEO Magda is very vocal at the moment, and a number of other CEOs are very vocal, and hopefully that does have some impact, but the risks are definitely high. And so while our base case is that the global macro will improve and the rand should weaken, we have taken more money offshore because the risks as we go into the BRICS summit, the risks as the SARB are weaponizing the rand could all see a lot more volatility and higher levels before we see better levels. So as unfortunately just a lot of uncertainty, no, bottom line is no strong catalysts. But maybe if the BRICS summit is confirmed that it's going to be in China and South Africa, that could be a positive catalyst. And as Madupe and Kasile and Kuberg come back online, that is a positive catalyst. But we've got to wait for those to happen before we start getting positive on South Africa. Sure, so that's where we are. A rather tough month. So let's take some Q&A. Yeah. Anton says, is FANG not very expensive? Not value for new money? Anton, as I said, FANG has done incredibly well. I mean, stocks like NVIDIA and AMD are up. They've nearly tripled year to date. So, there's been a lot of fantastic returns, which has made some of the stocks very expensive. So we are rotating out of some of the expensive stocks within the FANG fund, which should, we're trying to move into more value stocks. At the same time, we don't have any direct exposure to FANG in our balanced funds, as I've said before. We have that exposure through our S&P 500 and our MSCI World and our S&P 1200 Global. So basically, all the big global indices have exposure to FANG stocks because those are the big winners. Microsoft, Google, Amazon, NVIDIA are all top 10 in the world stocks. So that is certainly, we have the exposure. That's why we haven't added any extra FANG. And that's why we do like, for new money, our new money is flowing into US value because not S&P 500, because we are worried about short term being expensive. Long term, we think the story has a lot of legs, but there are the risks I've mentioned in terms of a lot of money has to be spent and not everyone's going to be a winner. Alex, just in terms of the first slide, US cash is just dollar cash, and so that's basically the return of money in the US in dollars, including rand depreciation, whereas SA cash is just the money you return in the South African bank account. Clive says, are we neutral underweight to overweight India? So Clive, we don't have an Indian building block or ETF. We have our emerging market 50 building block, which has some exposure to India, but we effectively are underweight India because we have our biggest exposure is to our EM50 building block, and then we've got a little bit of China on the side just to increase China in the short term. We'll probably take profits on China when it recovers. India right now, we think is quite expensive. And it is quite a narrow stock market. So we don't, it's one of the reasons why we haven't launched an India ETF. So I suppose, yeah, I think we are underweight India to a small extent. John asks about the global property portfolio. So yes, John, that's another one that hasn't done very well. As you all know, we haven't held global bonds for some time. For a short period, we bought US bonds and then we took profit on it when it ran very quickly, and that worked very nicely for us. But we're still in the camp of higher for longer global bonds yields, particularly in the US. So we do have a small allocation to global property as a proxy, because we don't hold any bonds. So we feel we have to have some defensive play, so that if we do hit a recession, if things do get bad, and the US does cut rates unexpectedly, well, we need something that's going to do quite well in that environment. We don't have global bonds, which in that environment would do quite well. So global property is the proxy. We also think that there are idiosyncratic risks that are priced into global property. A lot of the COVID risks are still priced into that. And particularly in the US, there's a lot of concern there's going to be defaults because of high interest rates. A lot of risks are being priced in, and we don't think those risks are going to happen. In fact, our global ETF is very well diversified globally, and it's also got a lot of very defensive sectors, whether it's cell phone towers or hospitals. So we think that the earnings are a lot more defensive in that ETF than the general property sector. And we think that general property sector globally is being hit by concerns that there are going to be defaults because of the rapid increase in interest rates. And so our ETF is being hurt by sentiment. And so we are holding on to that position. We're not increasing it, but we're definitely holding on to that position, and topping it up with cash flows as they come in. Andre says, AI, does the Sygnia Skeleton Balance 70 fund invest in some of the AI companies? Yes, Andre. So the Skeleton Balance 70 fund, which is my favorite, follows our global equity portfolio to the T, like all our other global equity funds, and it is invested in our themes, but it also has exposure to the MSCI World Index, which is its benchmark. So it's got a big exposure to S&P 500 and MSCI World, and the top 10 stocks in those indices are AI stocks. So AI has really benefited the big indices. It's not like 4th during COVID, when it was the small innovation companies like Zoom that did so well. In fact, over 1 year, the best performing fund in the global equity category in South Africa was the FANG fund, as I said. And then unfortunately, the 4th was probably in the bottom 10. And it's also an innovation fund. So it's very interesting that, one theme that is in 4th and certainly 4th has exposure to AI, but it's just one of the themes. But all the other themes like Zoom and solar panels and robotics and crypto and genomics and all those other great long-term themes that certainly are going to make the world a better place and are certainly going to see growth in revenues, they've been ignored, or they are being hurting because of two reasons. One, they're small caps, so they were impacted by the US banking crisis, and two, they have limited cash flows because they are new companies. Now, the FANG stocks, or the global big stocks, they benefited the most from that because and that's why we have the FANG fund. The FANG fund is all about the network effects. It's about the top 10 companies with the big moats that have huge databases of clients, and they can just easily roll out new services to clients. They can roll out the new Bart to Google clients, or the new Bing and to Microsoft clients, and they've got strong cash flows. So they're not worried about interest rates rising, and they've got their own ways of raising cash. They're not worried about small US banks. So they've just been an incredibly perfect storm environment for those stocks. And fortunately, all our funds have benefited from it, and the FANG in particular, but all our funds have benefited from that theme. And longer term, we think that there'll be a rebalance as the US banking crisis recedes and people are less concerned about US small caps going bankrupt because of high interest rates, and a recognition that other innovation will also have a place in the future, not just AI. And remember, AI LLM helps all other innovation, not just the big companies. So Cobus, yes, 4th fund is exposed to AI sector. In fact, we did an analysis. AI in general, and AI is a very broad concept. It's not just LLM. The AI stocks are about 50% of the 4th companies are exposed to AI in a broad sense, not the narrow ChatGPT sense. Bruno says, was the debt ceiling resolved or postponed to Jan 2025? What is the likely market impact on growth assets to the wall of treasury bonds to be issued shortly, and which will likely compete effectively with growth assets and bank deposits for capital? Bruno, that is a very good question, very complex question. So two simplified answers, apologies. One, the debt ceiling was resolved, but certainly there weren't nearly as many cuts to spending as the Republicans wanted. And there was nearly a mutiny in the Republicans because there was so little spending cut, which means that things aren't going to impact growth assets too much. Yes, it's kind of been postponed until the elections, so it'll be a 2025 event, but not any time too soon. So we're not concerned about the debt ceiling. In fact, the debt ceiling from a growth perspective was probably more positive than negative. The bigger issue which one raise is now that the debt ceiling has been raised, now the debt ceiling has been raised, the US needs to raise a lot of cash. And that is a tricky one because you've got quantitative tightening at the same time as the US needs to refill its coffers to help all the spending. So yes, it is definitely a risk that we're watching quite closely, that there could be a liquidity event because all of a sudden you've got quantitative tightening where the US is selling bonds, which means they're taking liquidity out of the market. And they're also at the same time having to raise capital to fund that, which is also taking liquidity out of the market. So it is definitely a risk that we're watching quite closely. We don't think that it's going to cause an event. We think that the US government will manage that, whether they will stop QT or not. They have the various tools, and it's something they're very well aware of, and they certainly are monitoring that risk quite closely. So while it's a risk, it's not something that we think is going to trigger any issues. George, thanks. Yes, unemployment is going to fall, which means unemployment is going to rise. Yeah, that apologies, that is an error. Employment is going to fall. Unemployment will rise. Alex, that's a brilliant question. Would you wait for the rand to strengthen before investing money offshore? So as I said, we've done two things. We're forecasting the rand to strengthen, but we also took more money offshore this month because we acknowledge that the risks have risen. And we did a similar thing to China in September last year, where we cut our Chinese position, even though we were still bullish on China, because we recognized the risks had risen. And it's a very uncomfortable thing to do. We don't like having to basically take a loss, but stop losses are very important, and we have stop losses on all our positions. So yeah, I'm not sure. Our base case scenario is the rand is going to strengthen. So you could wait for the rand to strengthen, but at the same time, the risks have certainly risen and volatility is going to stay high. So the best thing to just tranche your money. We certainly, if the rand strengthens further to 18 rand to the dollar, we'll probably take more offshore, use that as a buying opportunity. But if rand weakens above 20, we might put on more protection. So I think the range has just risen from 16 to 19 to probably 18 to 21. So it's a higher range for now. Here says, please comment on the JSE introducing ETFs. Here it's very exciting. Certainly Sygnia is participating. We've already applied to launch a new actively managed ETF. I'm not going to tell you the details or the name, but we have applied for an actively managed ETF. But when it comes to actively managed ETFs, and I did put out an article on this, I think it's very important to make sure that you monitor the spreads. The reason that normal ETFs work so well is because they're fully transparent, because they're passive, they are low cost, and they have low spreads. Actively managed ETFs, by their nature, will have higher costs because they're active, not passive, and higher spreads because the market maker has to work a lot harder to hedge their own risks. So before you jump into any actively managed ETFs, just make sure you look at the cost and look at the spread, because the overall costs are higher than standard ETFs. ETFs are your perfect low-cost vehicle from a spread and a management fee and a TER basis. Actively managed ETFs give a lot more opportunities, but expenses rise and spreads rise. So keep a lookout for that. Christopher asks about BRICS countries establishing its own currency. Christopher, that's again a great question. I think that's going to be that talk's going to continue for a long time. I can't see the BRICS agreeing on its own currency. Right now, the BRICS can't even agree whether they should be expanding the membership. And the BRICS certainly are, they're a very diversified bunch, and they've got very different ideologies, very different alliances, very different political views. They are a lot more harder to align than NATO, for example, and some of the traditional developed markets. So I can't see there being a BRICS currency anytime soon. But as I mentioned, there certainly is a big move away from the dollar, where India is now trading directly in rupees, and China is trading directly in yuan, and that's, as I said, France, Brazil. We're seeing basically the rest of the world, the South America, and Asia moving into non-dollar denominated currencies, and that's going to have to see a weakening of the dollar, just as we move away, and it'll probably lead to an increase in the increase of yuan, an increase in the Indian rupee, probably the yen will increase and the euro will increase, all at the expense of the dollar. But having a single currency that replaces the dollar, I can't see it happening anytime soon. That, maybe in 30 years, but not in the short term. Sean says, is not the bulk of inflation driven by administrative pricing? I presume, Sean, you're talking about South African inflation and not consumer spending. Yes, Sean, it is. Fortunately, oil prices are very low globally, and that is actually thanks to China and India, who are buying Russian oil well below the cap, and they are able to keep global oil prices low. So despite the weak rand, we actually are seeing oil prices fall, which is good for South Africa and good for our inflation. But yes, administrative prices, basically, especially Eskom, are causing inflation in South Africa to rise. So, and we can get into a whole big debate on monetary policy and whether you should or shouldn't raise interest rates to combat inflation, which is due to administrative pricing, i.e., you have less impact. If your price of electricity is going up, why should you raise rates? Because it's not the consumer's fault. The bottom line is, right now, our monetary policy works like that. If inflation goes up, the target of the Reserve Bank is to target inflation, and so they'll make sure that even though you're spending more on Eskom, you will try and spend even less on a new TV or extra inverter, whatever you may need, so that inflation falls. And basically it means that you'll have disinflation or deflation in your consumer spending to balance the high inflation in your administrative sector. So a very difficult environment for the consumer. That's why our consumer stocks are down so much. I'm sure you've seen Spar down 30% in the last 2 months, Pick n Pay down 30% in the last 2 months, Tiger Brands down probably 40% in the last 2 months. I mean, the SA consumer is being destroyed. It's really bleak out there, and that's why we're favoring South African bonds right now. While we think there will be a recovery, it's at least 12 to 24 months out from the SA consumer. Yep, Mr. Naka, I agree on both your points there. Anton, commodity recovery is good for the rand. And clearly, South African exporters, so commodity producers and our farmers certainly do well with the weaker rand. So we do have that balancing part of our economy. And as we've said before, certainly our listed market, 70% of the top 40 index is linked to foreign revenues. So there is a weak rand does help our South African equities and our farmers and our miners. So it's not all bad, a weak rand. But it does, the weak rand is a problem for interest rates, and it's a problem for our debt consolidation. Tom, it's a very long question. I'm going to skim this. Yeah, Tom, it's a good point. Certainly, there are big structural imbalances right now. Definitely, when it comes to trade deficits and trade balances, and the fact that the world is becoming increasingly polarized. There's a lot of reasons why things aren't going to be as rosy going forward as they were in the past, and that's why we are on the Japanification roadmap, why we do think that volatility is here to stay and that equity returns are going to be a lot lower than they were in the past. And so we've got our themes, which we think will be relatively insulated against a very poor outlook globally, and things are tough. It brings a lot of people to gold. I think gold is a short at these levels. Yes, one of the reasons that you could be buying gold is because emerging markets are buying gold. Emerging market sovereigns are buying gold. So they are diversifying away from the dollar. That's going to continue. So that is certainly a demand driver for gold and a reason to be bullish in gold. But gold is incredibly expensive, either as a currency or just in terms of a mining cost, the marginal cost of mining. So, fundamentally, it's difficult to excite about gold. And what my question to you, with everybody when it comes to talking about gold, and why we remain short on gold. And someone can answer this to me, please send me an email. That in 2014, gold and platinum traded at parity. In 2008, when there was load shedding and South Africa being the primary miner of platinum, platinum price skyrocketed, way higher than gold. Now we're at a point in time where gold is double price of platinum. We're going through load shedding. We're struggling to get platinum out the ground. Platinum is more precious than gold. Platinum has industrial uses, which gold doesn't have. If it's all about looking for precious metals that are inflation hedges going forward, why hasn't platinum recovered? It's just a good question. I can't answer that, and it's one of the reasons why we stay away from gold. Yakov, hopefully I answered your question about SA catalysts. It's either about being more neutral from a political stance against Russia, so that could be not hosting the BRICS, or it could be the load shedding reducing because of Kusile and Coburg and Madupa all coming back online. We need to see some catalyst. Unfortunately, just getting cheaper doesn't help. When we get stuck in a value trap, things get cheaper and cheaper. The good thing about bonds, and why I'm more comfortable actually buying bonds, is bonds tend to be more mean reverting than equities. So you don't need as much of a catalyst from a bond perspective as you do from an equity perspective. Have you asked about FANG? Yes, FANG strategically, as those very strong network effect companies with wide moats, they are great companies. The biggest risk to FANG stocks is antitrust issues. Certainly, the US is way behind on antitrust, and certainly the gains that have happened year to date speak to very, very strong anti-competitive behavior in the US, and why only a few companies are able to benefit from AI and not a wider range. So I think there could be increased antitrust issues going forward for those big stocks, but you can't. They have got such deep moats; they'll be here for a while. Leon asked what I think about SARB interest rate decisions. Well, hopefully the SARB becomes less political in their next meeting. But I think with the Rand where it is, we've got to have at least another 25-point increase unless the Rand strengthens. So we'll see what happens. So that all depends on political events. It all depends on global events. If commodity prices rise and the dollar weakens and the Rand strengthens as a result, we may not have a hike. But if there's delay in the dollar weakening and delay in commodity prices rising, or increased political risk, which causes the Rand to weaken further, well, we could even have a 50 basis point hike. So data dependent, a lot of uncertainty. Gil asks, what's his outlook for South African inflation and global inflation high for longer, as I said, even though it's going to continue to roll off as supply constraints improve and as demand destruction improves, but we are, we're not going to get down to 2%. I think next year will be closer to 3, not to 2 globally, and that will mean that high interest rates for longer. South African inflation, I do think is going to roll over from these levels. Again, Rand dependent. But the lower oil prices are certainly helping, and we'll see that impact. And yes, definitely demand destruction in South Africa, as you're seeing in the retail space. No big changes to the 4th hour index at the moment. Mervyn, yes, real yield is nominal yield minus inflation. Louis, hopefully I've answered your question. It's tough. It's a tough one. Why is Magda not running for office? It's a good question. I'm just very glad Magda's too busy making sure that Sygnia is a success. So I don't think she's going to be running for office anytime soon. Jacob, the reason I'm bullish on copper is I think that despite the setback in sustainable investing because of the Russia-Ukraine war, I definitely think that it's something it's a structural theme that's here for us. Climate change has not gone away just because there was a war, and the move into solar panels and wind is massive. The moves into having to have battery storage, whether it's electric vehicles or just because of wind and solar generation, is massive. And all of that results in a huge demand on copper. So, copper is something that's very, very sensitive to Chinese consumer spending. So while we are relatively neutral to bearish on iron ore and steel, that's very much infrastructure driven. But when it comes to the Chinese consumer buying another dishwasher or a stove, that's all very copper intensive. So it's a combination of the climate change move and the Chinese and Asian consumer coming through, and they're all going to spend a lot on copper. Mike, I can't give my view on skeleton balance 70 for a living annuity. It all depends on how much risk you want. But assuming that you're happy with that level of equity, the skeleton balanced range is great for an annuity. Maybe you want skeleton balance 40 instead of 70. It all depends on your risk profile, but they do go very well into a living annuity. If you're in our SURF umbrella and you're really invested in one of the skeleton balance funds, you can transition seamlessly into a living annuity in those funds. So it's a fantastic product. You really should look into that. Bruce, that's a good question. Investing for kids with a 5 to 7 year outlook, what Sygnia fund would be best suited? I'm gonna have to go with my usual, sorry, and go with skeleton balance 70. Yes, it's not 100% offshore, but I think that if the rand where it is, there's a lot of risk priced in. Skeleton balance 70 is your lowest cost. You can be guaranteed that costs are low. It's got good growth. It's got exposure to our themes. It's just very well diversified. So it's well diversified and it's low cost. And particularly if you're looking to pay for varsity fees in 7 years, unless your kids are going to Oxford, well then maybe you should invest in one of our global funds. But if your kids are going to school in South Africa, then you want something that still has some exposure to rand assets, rand equities, and rand bonds. And so skeleton balance 70 or 40 would be my preference, depending on your risk outlook. John says end of June is dividend payout time. Yes. Our funds do pay out dividends at the end of June. Some are monthly, some are quarterly, some are 6 months. So John wants to know which Sygnia offshore funds would you recommend investing his dividends into? Yeah, again, I'm going to go with the diversified answer. Skeleton Global Equity Unit Trust, that's 100% offshore, but it's diversified across all our equity funds. So if you want equity exposure and you want completely offshore exposure, then the Sygnia Global Equity Fund of Funds is the place to invest into. Or on our platform, if you want more defensive, we do have the Skeleton Global Cash Fund. It's only for endowments and living annuities and RAs, but that's if you want money offshore, but with no equity exposure. Thanks, Tom. Sean, good point. I think SA Big Business is starting to challenge the government. I think they're realizing that they have to stand up. Francois asked a great question. He says, would it be a good chance to use some of the high interest rates to make fixed deposits on a short to medium term? It depends on your time horizon, but right now we've got our enhanced income fund, which is got a 10.5% return because interest rates are so high. That could go up to 11% if interest rates go up further. It's a nice stable place to hide if you worry that things get worse, currency could weaken, and bonds could have another loss, a capital loss, even though bonds have an incredibly good yield of close to 11%. So, if you think that we're close to the worst, then South African bonds, you've got 11% yield with some capital appreciation. You think there's more downside, then enhanced income, you've got 10.5% yield with capital preservation, or our money market fund. So, those are two very good places to be. Or the Skeleton Balanced Absolute Fund, which is a very well diversified fund. That fund targets no negative returns over 12 months. It's got a nice real return target, so it's also something to look at. Mervyn asks, you said the Sygnia Dividend Fund made some minor changes. Yes, at the last rebalance, which was March, we reduced the amount of resources, and that's worked very nicely for that fund. Yes, it's still struggling because it has got resource exposure, but we did reduce the amount of resources in that fund. It's because of the higher volatility. Pierre, honestly, I have no idea where the Vanadium is going. Sorry. Thank you, Mike. So that's it. Thank you very much, everybody, for joining. I hope I've answered your questions. Just hang in there. It's been tough, but I really do think that this It's not that South Africa is a failed state, it's that the state has failed South Africa. And as South Africans and the Western Cape, to some extent, the government are going to see us through this. That we will see private energy usurp SOEs and Eskom, and it's just another painful thing that we have to get through. I saw President Ramaphosa said that South Africans don't need electricity, but they do need water. So on the one side, I'm not sure we don't need electricity, but the fact that the government is already looking into water, even if it's a bit late, that is at least good news. Hopefully we see some quick implementation on the water side as well before things get too bad, so that we don't have to sit with full bathtubs to flush toilets during water shedding. But it's South Africa. We love it. We're here. We've got well-diversified portfolios. Our equities have 60 to 70% offshore. We've got a good chunk of our portfolios offshore. We've got good hedges. So let's not feel too down, because your money is well looked after. Your money is well diversified, and we will get through this. So have a good June. Good luck for winter, and I'll see you next month. All the best.